You may have heard mortgage rates are going to stay a bit higher for longer than originally expected. And if you're wondering why, the answer lies in the latest economic data. Here's a quick overview of what's happening with mortgage rates and what experts say is ahead. Thanks for joining me today. I am Rosa Helen with Intero Real Estate. When it comes to mortgage rates, things like the job market, the pace of inflation, consumer spending, geopolitical uncertainty, and more all have an impact. Another factor at play is the Federal Reserve, the Feds, and its decisions on monetary policy. And that's what you may be hearing a lot about right now. Here's why. The Feds decided to start raising the federal funds rate to try to slow down the economy and inflation in early 2022. That rate impacts how much it costs banks to borrow money from each other. It doesn't determine mortgage rates, but mortgage rates do respond when this happens. And that's when mortgage rates started to really climb. And while there's been a ton of headway seeing inflation come down since then, it still isn't back to where the Feds want it to be, at 2%. This graph shows inflation since the spike in early 2022 and where we are now compared to their target rate. As you can see, we're much closer to their goal of 2% inflation than we were in 2022, but we're not there yet. It's even inched up a bit over the last 3 months, and that's having an impact on the Fed's plans. As Sam Katter, chief economist at Freddie Mac, explains, strong incoming economic and inflation data has caused the market to reevaluate the path of monetary policy, leading to higher mortgage rates. Basically, long story short, inflation and its impact on the broader economy are going to be key moving forward. Based on current market data, experts think inflation will be more under control and still may see the Fed lower the federal funds rate this year. It'll just be later than originally expected. As Mike Frattantoni, chief economist at the Mortgage Bankers Association, said in response to the Federal Open Market Committee decision earlier this month. The FOMC did not change the federal funds target at its May meeting as incoming data regarding the strength of the economy and stubbornly high inflation have resulted in a shift in the timing of a first rate cut. We expect mortgage rates to drop later this year, but not as far or as fast as we previously had predicted. In the simplest sense, what this means is that mortgage rates should still come down later this year, but timing can shift as new employment and economic data come in. Geopolitical uncertainty remains and more. This is one of the reasons it's usually not a good strategy to try to time the market. No one can predict the future. The market or interest rates could be down or could be up. If today's timing worked for you and you have the means to get a loan and you are seeing homes that you would like to live in, then today is the time to buy. If you have questions about what's happening in the housing market, or if you're ready to take the next steps in real estate, let's connect. I am Rosa Helen, offering you peace of mind in all your real estate needs.